Hey everyone, so if you're running a business, you've probably felt like taxes are just a one-way street, right? Money goes out and that's it. But what if I told you that the tax you pay on your business supplies could actually lower the tax you owe on your sales? That's the whole idea behind something called input tax credit, and it's a real game changer that we're going to break down right now.
So let's just start with a really simple question. Is it possible for a business to actually end up paying tax on its own taxes? I know, it sounds kind of crazy, but without the right system in place, the answer is a big fat yes. And it's a problem that can quietly bleed a company dry. Yeah, this whole problem has a name. It's called cascading taxes. It's basically a tax on tax effect. Let's make it simple. Imagine you're a baker. You buy flour for, say, 100 rupees, and you pay 10 in tax. So your total cost is 110. Now, when you sell your bread, the sales tax is calculated on a price that already includes that first tax you paid. You see what's happening? The tax itself is getting taxed. And this just snowballs at every single step of the supply chain, making the final cost higher for everybody.
And that, right there, is the exact problem that input tax credit, or ITC as we'll call it, was invented to solve. You can think of ITC as the hero of this story. It's the mechanism that steps in and breaks that tax-on-tax chain, making sure that tax is only paid on the value that's added at each step, not on the whole price over and over again.
Okay, so let's quickly get the lingo down. First up, an input. This is really just any good or service you use to run your business. So for our baker, that's the flour, the sugar, the packaging, even the electricity to run the ovens. All of that is an input.
And input tax? Well, that's just the tax you paid on those inputs. Simple, right? Remember that 10 rupees of tax our baker paid on the flour? Yep, that's the input tax.
And this brings us to the credit part, which is where the magic happens. ITC means the government basically says, hey, that input tax you already paid, you can subtract that from the sales tax you collected. So if our baker paid 10 rupees in input tax and then collected 25 rupees in tax on the bread they sold, they only have to hand over the difference, 15 rupees, to the government. The business doesn't actually shoulder that tax burden. It just becomes a link in the chain.
Now, of course, you can't just start subtracting numbers willy-nilly. Claiming this credit isn't automatic. There are some really specific rules you've got to follow, and they lay out a clear roadmap for any business owner.
It all really boils down to 4 key things. First, you need the paperwork. A proper tax invoice is a must. Second, pretty obvious, you have to have actually received the goods or services. Third, and this one is absolutely critical, your supplier has to have paid their taxes to the government on that sale. And fourth, you have to have filed your own tax return. You tick all 4 of those boxes, and you're good to go.
Things get a little bit more interesting when you're talking about big purchases, machinery, equipment, what we call capital goods. Here, you've actually got a choice to make. Let's say you buy a machine for 100,000 plus 10,000 in tax. If you decide to claim depreciation on the full 110,000 for your income tax, well, you can't claim that 10,000 as ITC. But if you only claim depreciation on the base cost of 100,000, then you can claim that 10,000 as ITC. Basically, the system's smart. It stops you from getting 2 different tax breaks on the very same tax amount. No double dipping.
All right, now before you get too excited and start trying to claim credit on literally every single business expense, hold on. It's super important to know that some things are specifically off limits. The law calls them blocked credits, and they exist for a good reason, to prevent people from misusing the system.
So what kind of stuff are we talking about? Well, a lot of it is expenses that could kind of blur the line with personal benefits. Things like food and drinks, gym memberships, or vacation travel for employees. You also can't claim ITC on goods that you give away as free samples or that get lost or stolen. And another big one is the cost of constructing a new office building.
And vehicles. Vehicles are a perfect example of how specific these rules can get. It really all comes down to the vehicle's purpose and its size. So a standard company car for an executive? Nope, probably not going to qualify for ITC. But a big bus with more than 13 seats that you use to transport your employees? Yes, that counts. A car used by a driving school to teach people? That's a tool of the trade. So yes, and a truck for hauling your goods? Absolutely. The whole point is to distinguish between what's an essential business tool versus what could be seen as a personal perk.
So we've gone through the what it is and the how to get it, but let's just zoom out for a second and talk about the why. Why is this system so important? Not just for your business, but for, well, the whole economy. To put it simply, ITC is really the backbone of any modern, fair tax system. Its entire reason for being is to make sure that the final customer, the person at the very end of the line, is the only one who really bears the full tax burden. For every business in the middle, it means you're just a pass-through. You're not being penalized just for being a part of the supply chain.
And the result of all this? It's crystal clear. Without a system like ITC, that cascading tax effect just bloats prices. But with ITC, you strip away all that hidden, layered tax, and what you get is more honest, transparent, and competitive pricing. It's truly a win for businesses, a win for customers, and a win for the entire economy.
So there you have it. Input tax credit is a seriously powerful tool that stops that tax-on-tax problem and helps make commerce fair. But it does leave us with one final thought to chew on. While the whole goal here is fairness, does all the record-keeping and compliance you need to do to claim ITC actually put an unfair burden on the smallest businesses? You know, the very ones who might need that benefit the most? It's a really important question to think about as this system keeps evolving.